professional investors. No one else comes even close to that record. Matthew McLennan is a noted global value investor, recently profiled as a top manager in Barron's. He is head of the global value team at First Eagle Investment Management, overseeing more than $100 billion in assets, as well as portfolio manager of several funds, including the flagship First Eagle Global Fund, where he succeeded great value investor Jean-Marie Eveillard. Since taking the reins in 2008, the Morningstar bronze medalist rated 5-star fund has delivered better than 9% average annualized returns, outperforming its world allocation category and benchmark on both a total return and risk-adjusted basis. The investment climate has changed markedly from a year ago. In 2017, the S&P 500 had appreciated nearly 20% and had its first perfect record of advancing every month of the year on a total return basis. That means with dividends added. This year has been quite different, with much more volatility, 3 down months as of December, including a nearly 7% decline in October. The Federal Reserve has accelerated the pace of its rate increases a bit to every quarter so far this year. And for the first time in more than a decade, what's called the U.S. yield curve inverted, at least part of it did. That means longer-term interest rates fell below shorter-term ones. In this case, the yield on the 5-year Treasury note fell below the yield on the 2-year Treasury note. Historically, when longer-term yields are lower than shorter ones, it reflects expectations of a slowdown in economic growth and signals a recession could be a few months away. Not so, says our top economist guest, Ed Hyman. He believes a recession is several years away and that the economy has a lot of life left.
I study the economy.
Yes.
And I have 10 different models that I've developed that are independent, and they all indicate that the recession is years out. So, for example, real Fed funds are 0. You know, Fed funds are 2.25,
right?
And the inflation rate came out this morning was 2.4.
So minus inflation, it's 0.
Yeah.
Okay.
And that's really early in the cycle. Say last cycle, I think it was 200 basis points positive. Inflation was well above, or Fed funds were well above inflation.
Right, 2 to 4 percentage points.
Yeah, as one slightly more esoteric. In the last 3 expansions, when profit growth peaks, the next recession is about 4 years out, and profit growth right now is probably peaking at 25%. I have a series of those, and then just a little bit common sense. Inflation is still not a problem, and interest rates are still really low. I had dinner with the group last night, and I asked them this same question. It was a pretty high-powered group, and the consensus was 3 years.
Really?
There's a general feeling when you ask people that the recession is quite a ways out, and that's what I think.
So what's so interesting, though, is I get a lot of research. I do not have high-powered dinners, but I do get a lot of research, and everyone's talking about a late-cycle economy in the U.S.
So I'm a mid-cycle guy.
I know, and you just came out with a report to clients that said we're in the mid-cycle of our economy, 10 years into an economic expansion.
So in 98, which was sort of late cycle, the recession started in 2000, but the S&P had a 20% drop in 98. And growth that year was 4.5. The growth the next year was 4.5. And I think growth in 2000 was probably 2.5. And it fell off the edge. But I think the recession is still a ways off. I also assume that the Fed will not make my prediction wrong.
Right.
Which they could.
They could if they continue to raise interest rates at a rapid pace or whatever. What's your take on the economy? Because you have talked, Matt, about it being late cycle.
Well,
right?
from an investment standpoint, it is definitely felt later cycle, just based on where valuation has gone to. We don't really try to predict where the economy is going to go. We just don't think we can. But I think we have some question marks in our mind. For example, I acknowledge Ed's point that interest rates are low, but the stock of debt is high. So we're not quite sure when interest rates will be high enough to force a slowdown. But if levels of debt are higher, arguably it takes lower real interest rates to create a slowdown in the economy. The second thing that I mentioned is that profit growth is good. However, we believe that a lot of that profit growth came from late cycle fiscal stimulus. It's very unusual with unemployment below 4% to get the sort of fiscal stimulus that we got in the last year, and I think that that really has propelled corporate profit margins to high levels. As we look forward over the next year or two, that fiscal stimulus is going to taper off, and companies may eat away from the tax benefits they got from that fiscal stimulus package. So behavior has been perhaps more late cycle in credit markets as well. We saw fairly lax terms and conditions in the bank lending market. And so it's those kinds of considerations that we look at. And just from a common sense standpoint, unemployment below 4%, we haven't been here for over a generation. And usually the economy doesn't stay at these levels of unemployment indefinitely. So we acknowledge everything that Ed is saying. It's just that objectively speaking, from a price standpoint, we have some question marks.
And Ed, let me ask you about inflation, because wage price increases, for instance, that's one of the phenomena for trends that's cited by people who are saying that we're late cycle, that a recession might be closer than what you're saying. But you're saying inflation is just nowhere to be seen. But what's going on?
Well, what's going on is technology, globalization, intense competition are the factors that are forcing it. But on the numeric side, the core PCE deflator, which is what the Fed watches, or say an inflation measure, has already slowed to 1.8, below 2%.
Right.
And I think it'll slow to 1.7 by December. And this morning, they reported the data on productivity and unit labor cost. And with that, they give you compensation, so a measure of wages. And the revised compensation down from 2.8 to 2.2, which is a stunning. I mean, 2.2 is really low. And so that puts unit labor cost at about 1%. And if unit labor cost is 1 and inflation is 2, then profit margins would naturally go up. And I'm not sure whether that's late cycle or not, or early cycle, but it's it feels like the Fed will tighten one more time in December and then stop. Because of, I guess, a dozen things that have happened in the past 3 weeks. Oil coming down, stock market being weak, inflation not being there, and then you have a constant, still a constant risk of a trade war, which they have to take into account, and Brexit, and Italy.
Right. So there's a lot going on that would make the Fed cautious. And there's been this phenomenon, obviously during the Obama administration, everyone was complaining about slow below, subpar growth, below normal recovery growth.
Yeah.
Is it possible? And we've talked to both of you about the fact that we've had an extended recovery because growth was so slow. Then growth picked up in 2018, Ed. But Matt, looking at you, I mean, is it possible that we're in just one of those situations where we can have an extended recovery, and where conditions are, are okay, and that valuations, don't get out of whack, especially considering the correction we've had in recent months.
So even though growth was pretty strong last year, when we look over the last decade, 2%, and on the surface that looks like a number that's slow and steady and sustainable. However, that was fast enough for unemployment to go from 10% to below 4%. So it indicates a trend rate of growth that may be much lower than we were accustomed to previously. And so when the fiscal stimulus comes out of this economy, we could revert to a disappointingly low rate of growth. It's just a potential for risk, but it's one that's out there. The second thing is that one of the things perhaps the Fed is responding to is what's happening in asset markets. When you look at the stock market, even though the S&P is basically flat for the year, there are sectors of the market that have been quite weak, particularly some of the older economy sectors, construction, parts of financial services. There are areas that have been responsive to these interest rate increases. The shape of the yield curve is flattened. High yield credit spreads have started to move up. measures of risk perception, such as implied volatility, have moved up. And so the Fed is probably looking at all of these things and saying financial conditions. The big unknown here is that the Fed is shrinking its balance sheet. Quantitative easing was a huge experiment. I think that it was helpful to asset prices, so the unwinding of it poses another question mark, that's just an unknown.
Right, so, and your response to what Matt's,
Well, of course,
saying.
Matt, he knows everything. And I'm serious, I mean, very good insights.
Mhm.
I listened very carefully, and those are all very good question marks. The Fed certainly begs the question. Given the entire backdrop, I think the Fed would probably be well served to take a pause
Right,
and look around and see exactly what they've done by raising rates this much and by shrinking the balance sheet, which is an unprecedented event.
so let me ask you, Ed, about your economic outlook, because again, a year ago when we were here, you predicted a pickup in economic growth in 2018, which happened. And one of the reasons that you said driving it was the bull market, was a rise in stock prices,
Right.
this wealth effect, was how important that was to the economy. So now we've had corrections in the market. Tell me what impact the corrections in the market are going to have on economic growth going forward for the next
They're gonna slow.
6 months to a year. So
They're gonna slow the economy.
GDP is going to slow.
Yeah, so I'm
Right.
forecasting GDP to slow to 2.25, which is slightly above the 10-year average that you point out. But like Matt points out also, 2.25 apparently was enough to keep the labor market tight. The wealth effect has gone from about 10% year on year
Right,
for consumer net worth, now it's around 5%.
it's a big decline.
Yeah, and that knocks about half a point off growth in itself. A lot of the tailwinds we've had,
Yes.
like low interest rates and now higher interest rates,
Mhm.
we don't know exactly what the impact is of QE, but you have that shrinking QT, they call it, quantitative tightening, and then you have less wealth